Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me for this segment, we have Steve Wyett, Chief Investment Strategist at BOK Financial, as well as Steve Sosnick, Chief Strategist at Interactive Brokers. We're here to discuss why investors should separate the noise from the news and avoid slipping into that reactive stance. It is great to see the both of you. As always, just had you guys in studio last Wednesday, and a lot has happened since then. Steve Sosnick, when you see a day in the market like we're seeing this Monday, March 10th, you really do have to think about that mantra, thinking longer term and trying not to get wrapped up in the noise. It's not easy, but you have to do it.
Absolutely, Joe. Today I'd say constitutes a little more than noise. This is definitely a big, broad move, but we're still not seeing that. We're still not seeing that sort of 8 to 1, 5 to 1, get me out kind of day. It's very much centered along the biggest cap stocks, but those are the ones that so many investors got so caught up in, and for good reason. They were great performers, but this is something we've discussed here together, and that is if you have a trade that gets very, very crowded, or you have indices that get very, very top heavy, if everybody's long or everybody's overweighted or everybody's at least fully invested in a certain cadre of very, very popular names, if the mood changes, there's not a lot of natural buyers left, and that's kind of what we're seeing now. Is
Mm.
the sellers, for better or worse, I don't like to say there's more sellers than buyers, because somebody's buying every share that's sold, but the sellers are far more motivated right now than the buyers are.
Yeah, and Steve Wyatt, when you think about it from that perspective, it's clear that it's not just because it's hitting, certain technical levels and it was overbought at some point. There are a number of fundamental factors, and I think the market is just trying to figure out what tariff strategy, policy strategy, what that's going to look like at the other side of the rainbow, hopefully. And once there's more clarity, it's hard for companies to be able to direct their operating guidance, and it's hard for investors to judge.
I think clarity is the word that any and most market participants would say they want more of. Look, the technicals did play a part in this. We did see the major averages tick down to the 200-day moving averages in a number of cases. There was some hope that that would be some area of support when it looks like that's not it. That's probably what's triggering some of this. I think Steve's right. I mean, I can remember back in a previous life when you had like Janus 20, which was a very concentrated mutual fund holding that a lot of people held that just did fantastic performance. But once they started getting liquidation requests, redemption requests, they had to be a seller of those stocks. And it was just very hard to get out that door. I think that may be some of what's happening in one sense. And I'd be interested to get Steve's take on this. You mentioned the breadth. Look, this is an index issue, but it's the stocks that's been driving the index. The broader market isn't taking the same amount of heat as what the top of the market is. So I would take some comfort in that, except that, it's still hard to look at. We looked earlier, the Nasdaq's down over 4% today. So you tack that on top of, as you said, Jill, just all of these policy actions. And I really think it's the speed at which we're moving that just increases the implementation error. And so that just heightens that uncertainty. It heightens the fear factor, if you will, a little bit. And if you're have any question at all about that, when the markets are uncertain, they're going to go down. They don't go up with heightened uncertainty.
Well, Steve Sosnick, you had made this point last week, and actually a number of times, that this also changes the liquidity profile when you're trying to get in and out of names as well, particularly when volatility picks up one way or the other.
Yeah, I think on Wednesday I referred to it as volatility begets volatility. But yes, the liquidity does get a bit worse. And what happens is, this is the way traders react, is uncertainty is volatility reflects uncertainty. And so if you're more uncertain about your risk reward profile as a trader, what professional traders do, and I think what individual traders should be doing, is you're less willing to commit the same amount of capital for the same amount of profit. So as a market maker, what we used to do would be, we would widen our bid ask quotes and shrink the sizes that we would post on each quote. Well, that is a way of sort of demanding a little more profit for each trade and risking a little less on each trade. The problem for the markets is, if everybody does this collectively, it means that it doesn't take as much to move the market in one direction or another. If you have those motivated sellers, that those press down the market more, because if they're willing to, in any situation, if you have somebody willing to cross a bid-ask spread, that moves the market a little bit. But if people are willing to cross very wide bid-ask spreads, well, that moves the market a lot. And so it doesn't take as much to do that. And so to Steve's point, where you talked about like the concentration, throw that on top of some very important concentration. I love the Janus 20 example, because I was probably prepared to go back to like the Nifty 50 of the the 60s and stuff. Yours is much more timely and relevant. But that you throw that in there on top of all this, and this is what you get. And there's, between the policy uncertainty that Steve mentioned, we also haven't even brought up the idea of the government shutdown potentially on Friday night. I mean, there's a lot out there that could be spooking people. And all the uncertainty becomes volatility.
Yeah. Well, I mean, Steve Wyett, I'm looking at the corner of my eye here on my TV, and I'm seeing, sectors down 4, 5, 6%. So, many of the larger banks down 4, 5, 6%. Some of the Nasdaq 100 names, double digits. I mean, 17,
Yeah.
15, 20%. At some point, and we know this is going to take time to, reverse policy and put a new tariff strategy and so forth. The fundamentals are going to start to look really attractive. If you wanted valuations to come down, and they certainly are, at some point, the fundamentals are going to start to make sense, because a lot of these companies can operate in challenging environments.
Yeah, I think that's exactly right, Jill. Look, I think it's an important point to make that, markets have been this volatile in the past. They're not acting outside the realm of what we would expect. By the way, they're going to be this volatile again in the future. So this is just part of being involved in the markets. You're going to go through these periods of time. I love what Steve brought up about the market makers. Look, you start widening bids and lowering bids, and you keep getting hit. That just shortens the amount of time. They turn into sellers immediately too. So there's nobody standing there taking the position for any period of time. They're like, they don't want to risk the capital. So I understand why the market works this way. But at some point, you're absolutely right, Jill. You start to look through and say, man, this company's worth more than what it's trading for now. And to the degree that this is an unwind of some companies that were probably overvalued and overowned, we're going to get back to a level where we can say, you know what, okay, this is a lot better starting point, and we're going to move up from there. I think to me, the volume of the number of policy changes that we're looking at, it's not just one thing. It's just so many areas that this might take a little bit longer than what we've seen in the past. Policy uncertainty levels at near record highs, except for a very short period of time during the pandemic. So these are the types of areas that you say, okay, I think professional investors they're not scared of these kinds of markets. This is when they start to perk up and say, when can we look for some stuff we really like at what is now looks like a much better entry point than where we were only a short time ago?
Right. And Steve Sosnick, at the end of the day, too, there is still a lot of cash on the sidelines. And when you're a long-only manager, you're getting paid to find those ideas. You can't just sit in cash until these things kind of, play out.
Well, that's true. And we have seen money flowing into utilities and consumer staples, which are classically defensive sectors. We've been saying this for a while, that this is when, low beta and high dividend paying stocks tend to shine. And that's been proven out. So yes, long only managers do need to stay invested. And that is where they tend to look when things get a bit thorny, as they are now. But one of the things I want to say to the more, let's say, trading oriented accounts is I never want to tell people not to buy stuff that's on sale. And boy, there's some stuff on, clearance today. But I think the key here is, is it a value, to Steve's point? The key is taking your time and discerning what is a value versus just what happens to be marked down 10%. And so that's where a lot of the challenge comes. That's where the challenge comes for long only managers. It's a little difficult now because you have market correlations being so high. A stock picker's market is typically better when there's some dispersion in the market, because you have the good stocks going up, the bad stocks going down, et cetera. Right now, there's a lot more down markets bring a lot of high correlation, and that's tricky for stock pickers. But I think this is when a very measured approach is important. And there's always time to be looking for value, but I think discerning it right now is a little more challenging than usual.
Yeah, it
And
certainly is.
Jill, I would add to that, if I can jump in on that too. This is where the amount of the overvaluation that we saw in the market is a little bit different. I mean, we're down, but we're still, if you look at the PE on next 12 months earnings, we're still above historical averages by a pretty fair amount. So for stuff to get cheap fundamentally, we're talking, Steve, I don't know if you'd agree with this, but I think cheap fundamentally, we're still a little ways away from that. We're closer than we were, and we haven't yet seen a lot of significant damage to earnings estimates for 2025. But that would be the next thing that I would start to look for, is if we start to see some movement there, which alters that valuation picture just a little bit. Again, I'm not trying to, I'm not saying that we have to go down a whole lot more from here, but there's some other, maybe some check marks, if you will, Jill, of where we get to what I think would be a more durable kind of a bottom. There maybe are some more check marks that we need to see get checked off.
Yeah, I mean, it's a great point that you make. Look at the run up that we had going into this. So, kind of works both ways when you think
Sure.
about coming back to the mean and what's a more reasonable valuation. And to your point, Steve, what are reasonable levels of support and resistance that make more sense, particularly in the U.S. domestic markets. Appreciate your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.